Well, I would say the Tiffany is up because it wasn't as bad as people thought it was going to be, and they didn't say things that were as scary as people thought they might say about what was going on in the world, because they're facing into some pretty tough business, right? They're looking at difficult business in China because the China economy will probably slow if these tariffs go on. They'll be facing tariffs on their inbound goods, and on my list of companies that sell into China, they're number one as far as the percent of their business. So those are all bad news items. The U.S. business wasn't great. The Chinese business, just reported, wasn't great. Gross margins were lower and expenses were higher. All of those you would have thought might have gotten their stock clobbered.
Right.
But they were okay, and since they were okay, the stock first reacted negatively, then it reacted positively. I would say nothing's really happened, and most of the world has Tiffany rated a hold, and that's kind of what they got.
Court, what would you add on that?
Yeah, I think those are all sort of good ways to sum that up. If you look at the dividend yield, that's higher. They also raised their dividend. We looked at that at a number of other stocks as well. I'm not necessarily saying that's a reason why the stock is higher, but that's some things that folks are pointing out today, at least.
And it's interesting you mentioned that today because because the 10-year is so low, the entire S&P basically has a dividend yield that's now looking more and more attractive. So whether it's that or just because the whole sector is, the fact that it's the best day since January, I mean, that was a good tell in early January for what was coming for the next couple of months.
That's true. I mean, and think about some of these earnings reports that we've gotten. We've seen a name like, Canada Goose sell off 20% on the back of its earnings, or Abercrombie and Fitch sell off 20+%, and they actually reported a growth in comparable sales. So we've had some pretty outsized reactions and a lot of fear of the unknown. We talk about that every day with the uncertainty about what could potentially happen if we have the fourth tranche of tariffs that go into effect. If that happens, none of the retailers are accounting for that right now because it is such a big unknown. But that could really hurt. So I think we've had some accelerated pain that maybe was a little bit too early.
So, Jan, if there are more and more additive tariffs, who loses the most? Who loses the least?
Well, we know
and who potentially gains.
If they add 25% on 325 billion additional goods, plus the 25% on the first 200, which is only at 10 right now, it'll basically wipe out a year of retail earnings unless they can pass that all through. And I've said all along they can't pass it through. On the other hand, it's worse for some people than other people. It's bad if you're in electronics. It's not so bad if you're in do-it-yourself. It's not so good if you're in apparel because that hasn't been hit so far, and now it will be. On the other hand, apparel's moving out of China as fast as it can anyway. It's really bad if you're shoes. They have on average a 12% tariff now. If they wind up with an average 37% tariff, that's really got to be difficult to deal with, and shoes are hard to move. So it depends on where you are, but it's not good for anybody as far as retail goes. The only way this can be good is if it works and China drops all their tariffs, we drop all of ours, and we all sing Kumbaya and it all works out. But if the tariffs go in and stay in, retail has to move out of China. Not good for China and expensive to do. In the long run, everything's going to move out of China anyway. It's getting too expensive to do business there, at least for my kind of companies. This just would accelerate it, but it would be a tough 18 to 24 months.